Hey guys, this is Justin here, and this is a video tutorial for an indicator called WaveTrend 3D, which is a free and open source script that I've published recently for the TradingView platform. This script was recently featured as an editor's pick on TradingView, and because of that, I have been getting a lot of requests for me to make a video that I guess goes into more details about how to use the indicator itself. So in this video, I'll briefly go over the original WaveTrend indicator for those who may not be familiar with that, and I'll discuss some of its strengths as well as some of its weaknesses. And from there, I'll introduce you to WaveTrend 3D, which is basically my complete reimplementation of the original indicator that was specifically designed to address a lot of those weaknesses. So this video will be segmented out by section, so feel free to skip ahead if you just want to know more about something specific. So for WaveTrend, or WaveTrend Classic, as I will refer to it, it is a very famous technical indicator that is not just famous on the TradingView platform, but also on many other platforms out there as well, including Thinkorswim or even MetaTrader. It was originally brought to the TradingView platform in 2014 by this user here called Lazy Bear, and he stated that he basically copied it over verbatim from other platforms. In fact, since he did that, if I go to the standings here, you can see if I sort by the top scripts of all time, he is actually in the top 4. He's the 4th most liked script on the entire TradingView platform. So even if you look into the top 30 and even the top 40 scripts, you can see what is essentially exact clones of this script with some people adding on additional features here and there. So it's definitely very popular, and with everyone basically copying each other, it wasn't exactly clear to me at first where this algorithm actually originated. So I did do a deep dive on this topic, and it turns out that the answer to that question is all the way back in the 1980s. All the way in the year 1980, there was this algorithm that is lesser known, made by a company called AIQ Systems. And they published this algorithm called the Trading Channel Index. And according to this article that I found, which is published back in 1996, this algorithm was specifically designed to be an improvement on the CCI, which is the Channel Commodity Index, and that was actually only introduced also in 1980. And for those of you that don't know, CCI is a very famous algorithm, so much so that it is actually a built-in on many platforms, including TradingView. And visually, I always thought it looked sort of like a crazy volatile RSI, and actually, part of the goal of this TCI indicator was to smoothen out the CCI calculation so that analysts could basically have an easier time identifying the true inflection points in the graph. So for the most part, I think they did succeed in this goal. And even though it was initially only for the calculators, like the TI-59 handheld calculator, eventually the PCs did come around, and it was available on the first versions of Windows, as I understand it. So even in Lazy Bear's original code, you can actually see it referred to as TCI, which I thought was kind of neat. But people have just copied it so many times, no one actually knows where it came from anymore, but now you do. So with that background, what actually makes this indicator so good and so popular? Well, from what I can see, it actually has 3 fundamental strengths that make it a very potent indicator. Its 2 biggest strengths of these 3, in my opinion, are its ability to help identify inflection points, which makes complete sense since that's what they really designed it to do. And the second is its ability to help identify divergences. So one way it accomplishes this is through a mechanism that many have come to call the trigger wave approach, whereby any smaller wave, such as this one, that's preceded by a larger wave, that is usually an indication that this is a trigger for a massive price movement, or at least a noticeable price movement. So in this case, it is indeed showing you a decrease in bullish momentum, and that usually means that there's this bearish correction phase that will follow. So you can think of this in a lot of different ways. Sometimes it helps to think of it as just a lower high, for instance. Sometimes people like to think of it as a neckline, where you have a head and shoulders pattern right here, and you can almost kind of see it up here if you really tilt your head. But yeah, there's different ways of thinking of it, but the main idea is that it does help you identify these moments of divergences. And the last strength, which honestly, I think you could think of this as a weakness too, because it can be pretty dangerous, but it tries to give you a sense of overbought and oversold conditions as well. So whenever there's a shift in the regime, for example, and the market suddenly goes from ranging to trending, these zones really can't be depended on very much for reliable indicators of being overbought and oversold. I'm looking here. It looks like one example of this is kind of right here. You can see that this was very much in a ranging state, and then all of a sudden, you could really get faked out if you're not really paying attention to other time frames and whatnot. Because this is definitely an example of like the whole whipsaw effect, where you suddenly get slinged into another direction, and these red zones, like, it goes out the window essentially, because you blast right through it, and then you can continue up here for really as long as the market wants. And that's the kind of scary thing. There's no actual bounded extremes here, and it can just like continue going up, and it can just stay up here for as long as it wants. So that is one thing that is potentially very dangerous about WaveTrend. And if you have used this in the past, you've probably noticed that it's particularly weak whenever the market transitions from a ranging to a trending state. So you can easily lose track of this bigger picture if you're not careful. And I think just to kind of follow up on this weakness, it's really not good for giving you any insight into other timeframes. And I think this is a problem that a lot of indicators tend to have. It all stems from the fact that when we think of these charts, we tend to think of these two-dimensional graphs of these oscillators, when in reality, they're really more like 3 dimensions. And if you start to think of them like this, you can almost visualize like a 3-dimensional sound wave, like I have in this graphic over here. So as you can see down here, it's really important to keep in mind the bigger picture whenever you're looking at varying frequencies across a time domain, because whatever happening in these little frequencies is not necessarily representative of what's happening at these much larger frequencies, which could carry a lot more gravity. And really, it's the best trading opportunities are identified by those rare moments when suddenly all of these frequencies start to synchronize. And that's when you get these incredible opportunities that create these like big impulse waves, where you could like start trading in a given direction. But obviously, the ability of PineScript to render 3-dimensional waveforms is not as advanced as like other languages, for example, like Python. But I did try to simulate this effect by just making these like contrasting color gradients and overlaying them in such a way that you could actually see like the different time frames that are based on different look-back lengths. And the way they kind of blend together shows you the points where the waves are reinforcing, and the points where they start becoming weaker, or where it's kind of canceling out with each other. So that was the initial inspiration behind WaveTrend 3D. And as far as like why this is a really efficient approach, I made this flowchart to kind of demonstrate it. Because if you look at the classical WaveTrend approach, you can see that in order to get their oscillators, they have to go through this pretty ugly chain of consecutive exponential moving averages. And they have to have a separate rescaling step, and they take another exponential moving average followed by a crossover with a simple moving average, and that gives you the oscillators that you're essentially following. So every step along the way, they're incurring a little bit of lag. But in the WaveTrend 3D approach, I'm using more modern techniques for transforming the original source series. So, for example, I'm using the hyperbolic tangent function, which it normalizes the signal and also serves to remap it into the range of -1 to 1, which is very nice. That's the reason why the hyperbolic tangent function is so popular for machine learning. It's often used in the hidden layer of neural networks, for example, to ensure things fall between -1 and 1. And after that, the second transform is just a Butterworth filter, which is basically a common digital signal processing technique that serves to remove noise from your source series. So those are really the only 2 steps here in comparison to all of these consecutive moving averages that will give you these final oscillators. And this is actually the WaveTrend 3D indicator in a mirrored form, but that's kind of how I originally envisioned it. But the default settings, as you'll see here in a second, are different than that. And I will take you through all of what I consider to be the most important settings to know. So now, before I do go through those default settings for WaveTrend 3D, I want to point out one thing that I think is very important to keep in perspective, and that is the whole time frame to oscillator relationship. So here I have 3 different time frames: the 1 hour, the 2 hour, and the 4 hour charts, all for Ethereum versus the US dollar as USDT, and a wave trend indicator loaded on each of these charts. So you'll notice that unlike the default settings, I purposely separated out each of these oscillators to show you what they actually are. So for each of these oscillators, the top oscillator represents the fastest speed oscillator, the middle oscillator represents the normal speed, and the bottom oscillator is the slowest speed oscillator. And what you will notice here is that when you are on the 1 hour chart, for example, this speed is essentially the same as the normal speed on the 2 hour chart. It's very similar. If you try to trace these waveforms, you can see that although there are some differences, they're more or less the exact same shape. And that is basically the effect that I was going for. And by the same token, this normal speed oscillator on the 2 hour chart is actually matching very closely the fast speed of the 4 hour chart. So the fast speed of the 4 hour chart, if you follow it along, it's actually matching up very nicely to these other 2 oscillators on different time frames completely. So this is actually a very powerful concept because it means that at any given time frame you're on, you can also keep in perspective what's happening in these surrounding time frames. So this is a pretty tricky thing to get right, because if you've ever tried to use indicators that use data from other time frames, chances are it looked pretty bad when the larger time frames were tried to when you try to overlay those, because they start looking like this horizontal line on lower time frames. So to accomplish this effect that I have here, I basically used a combination of different look-back windows, and for each of those oscillators, I had to add a certain amount of smoothing just to get it just right. But I finally got it to where it's approximating what other timeframes would look like. And that's a really powerful concept when it comes to making decisions, because like the question is, how can you actually use this now to frame your decisions? So one way of doing this is to actually get these oscillators to overlap with one another. And that's exactly what the default settings are. So on this chart that I have here, these are basically the settings for the default settings for WaveTrend 3D, and I've switched to now the 12-hour time frame for Ethereum. So what that means is my fast oscillator is approximately a 6-hour time frame, and my slow oscillator is approximately the daily time frame. And of course, the normal oscillator represents what's happening at the 12-hour time frame. Now, of these 3 oscillators, the 2 that are the most important in terms of generating the small circle signals that you see are basically the fast oscillator and the normal oscillator. And let me select this to show oscillator lines so you can see them a little more clearly. So you'll see that whenever the fast oscillator crosses down over the normal oscillator and it's above the 0 median line, that is when a small red circle is generated. And whenever the fast oscillator intersects or crosses over the normal oscillator when it's below the 0 line, that's when it will typically generate a small green circle. And however, like one thing I will say, do keep this in mind, just because a circle is generated does not necessarily mean that price will just go flying off in that direction. To get a better sense of where the actual trend is headed, it is necessary to look at this slower oscillator and basically try to determine if there's any simple harmonic patterns, for instance, that you can latch onto. So that's why this slower oscillator is bolded by default, is to kind of help your eyes, always follow in relation to where that is heading, because that definitely has the most gravity. So, for example, when you are looking for whatever it is that you look for, whether it's a Batman symbol, a head and shoulders, a cup and handle, a higher low, a lower high, you will see that as long as the circle that's being generated is in accordance with some sort of pattern. So for example, here's like a higher low. This is typically representative of a pretty good opportunity for an entry, because as you can see, there was quite a bit of bullish momentum that played out after this happen, because you had a higher low on a very slow time frame, the daily time frame, and meanwhile these lower time frames like the 6-hour and the 12-hour were colliding with each other. So when all of those stars align, so to speak, that's usually a good sign. So that's just the general thought process that you can take for when you're trying to identify which circles are more significant than others. Another very common question I get is, why are some circles bigger than others? And the reason for this is that some of these larger circles represent potential moments when there could be a possible trigger wave occurring for a specific divergence. And you can see some examples if we scroll back here. Like here's an example for a bullish potential trigger wave that formed. And if I zoom out, you can kind of see how, in relation to the previous circle, okay, that formed, this is, I think by default, I made it 40%. Yeah. So this is 40% the size of the previous magnitude that generated a green circle. So whenever that happens, this will be a little bit bigger, indicating that, hey, there is actually some weight behind this cross. And you might want to look at this a little bit closer, because it could mean a pretty big movement. And as you can see, like this is an example of the opposite time, when this was, 30% or less the size of this, and that resulted in, of course, this massive sell-off. So they're usually pretty good indicators, because it means that there's in general, a good amount of weight behind that particular cross. So I think those are like the most basic usages of WaveTrend 3D. I'll go through briefly now some of the other toggles in the settings menu. Let me move this over here. It looks like kind of an intimidating settings menu, but when it comes down to it, I think the most important settings here are really just toggles. So that's one thing to keep in mind. But this use mirror button, for example, will literally just mirror the signals across this zero line. And you may wonder like why you would want to do this. Well, if I turn off show oscillator lines, it sometimes calms down a little bit, and then switch that to none. So now basically you have this nice little representation that resembles kind of like this 3D sound wave. And you can kind of make some interesting inferences based on how these waves are overlapping with each other. So you can see that like within a larger bearish trend, there's like these little tiny bubbles of green showing you like, hey, this is bullish, but you're still within a bearish environment, for example. So it kind of gives you a different way of thinking about things. You can also, use it in a similar way to like identify whenever a divergence is occurring. For example, like if there's a smaller greens spike in relation to the last one, that usually means this is a bearish, bearish conditions are coming. So if you are a big cycle analyst and you use indicators like Tesla coil, it's also quite useful to overlay this against Tesla coil, or at least put them side by side so you can see how these colors relate to like the cycle and the movement of the cycles. So that's a pretty advanced usage. I wouldn't necessarily recommend that if you're just getting used to it for the first time, but that's one useful setting. The other useful settings are definitely these two here. So these are just an additional transformation that you can do to the signal to really smoothen things out. So I'll let you see what the effect looks like down here. If I show oscillator lines, you can see how it smoothens it out, and as I increase this, it'll just like make it more and more smooth, so you can really see the bottom line in terms of how much divergence is occurring at much larger time frames. And similarly, this is the center of gravity smoothing option, and this is quite interesting. I would encourage you to play around with it. I won't get into too much details on how it works, but center of gravity is a really cool smoothing technique because it's zero lag, and it gives you some interesting ways of visualizing upcoming price movements, because it just looks so drastically different than sometimes even what it would look like if you don't use that smoothing. So that's a really good one to know. The other ones on here, I think, emphasize speed. Usually that will just bold whatever it is that you select, and you can adjust the width of that particular signal to be more or less. So that's all visual preference. Another way is, so like with this slow one, you'll notice that it doesn't really generate any circles necessarily, but whenever it does cross over this zero line, that's usually also very significant. So whenever it manages to cross over the halfway point, that means there's going to be probably a trend change or something going on. So you really have to keep an eye on this in relation to this median line. And that's why it's bolded to begin with. But you can also, to kind of help you track it, you can enable these kernel estimators. And they do a pretty good job of showing you, for example, when it crosses over with a kernel estimate. And for those of you that don't know, kernel estimates are basically like a moving average, but in my opinion, so much more powerful because they're a lot less lag and they are adaptive to whatever is happening. So these are just two different ways of doing the same thing. This one is a lot more width, and you can see that even as it's going in a certain direction, the band will actually change colors, showing you what's happening. And typically when you see like the band changing colors frequently, that probably means you're in a ranging market, for instance. So that's a useful little trick to know. This, of course, you already saw. This just separates them out if you ever want to see them separately. And this adds an option to like emphasize the lines. Sometimes they just get in the way. So that's why that option is there. And finally, I'd say the newest addition that came about as a request from a lot of people were adding these overbought and oversold zones. And basically the way this works is it starts at the 0.5 and negative 0.5 zone because remember, since everything is mapped between -1 and 1, whenever it crosses that 0.5 mark, that means that's a pretty rare occurrence that only happens less than 25% of the time. So the rationale is that will typically represent a valid zone for a potential reversal, and that's typically what happens. Keep in mind it is relative only to the normal oscillator. So I wouldn't necessarily judge it based on the fast or the slow oscillators, but in general, whenever the normal oscillator makes it up to there, it is typically time to reverse either, if not that second, then soon at least. So that's a pretty interesting way of kind of visualizing reversal zones that a lot of people requested. So I added that in. So really, I think those are the most important settings to know, in my opinion. The rest are, either pretty self-explanatory or just straight up related to the colors. Like all of these down here are just all color related, and transparencies, you can adjust that as you see fit. But as far as the actual meat and potatoes of the indicator, those are what I would recommend for you to use. But by all means, feel free to play around with it. I spent hundreds of hours basically developing this indicator, including all of the research. So if you have any questions about it, or if you have suggestions on how it can be improved, I'm definitely willing to hear those. So always feel free to reach out. I hope that was helpful. Thanks, guys.